Hello again, I'm Megan, CEO at Clark Financial. Let's talk about where we've been with markets this year and where we may be headed. The first quarter was exceptionally strong as the market took off. The government shutdown was over and the Fed reversed its rhetoric on raising rates. There was real optimism that a trade deal with China was on the horizon. The good feeling persisted into April as the S&P 500 and NASDAQ hit all-time highs. That mood, however, was shattered as the trade deal with China was derailed and the tariff war began in earnest. Volatility unfortunately returned in full force in late April. The NASDAQ and the S&P 500 came off their highs and reported 4 straight weeks of losses, while the Dow ended down 6 weeks in a row. Although economic reports, including earnings, the unemployment rate, and jobs were strong, reactions to a trade deal snag with China began to dominate the news with dire predictions of slowing U.S. growth and also slowing global growth. Original speculation that we were close to a deal in May proved very wrong, and the negotiations between President Trump and the Chinese president got pushed into late June to the G20 summit in Japan. Tariff deadlines came, and with neither side budging, markets caved from late April to late May as a direct result of getting hopes up that the deal was close, only to show that the process was going to be a longer and more bitter struggle. By late May, though, the market seemed to realize that there was more news besides the China trade deal, and most of it was positive. Nearly all S&P 500 companies reported earnings by late April, with 76% reporting positive earnings per share surprises and 59% reporting positive revenue surprises. Other economic data also bolstered the market's ability to shrug off delayed deal news. Unemployment, which bounced up to 4% during January's government shutdown, dipped back down to 3.6% in Q2. Also, dire warnings for the first quarter GDP were not realized. In fact, Q1 19 GDP grew at a very robust 3.1%. The topsy-turvy quarter had yet one more surprise for us in June after a strong April and a painful May. June was heralded by news that the Federal Reserve was once again shifting its stance on interest rates. In just 6 short months, the Fed went from raising rates to staying put to now to potentially cutting them. A year ago, markets reacted very negatively at the slightest mention of the possibility of a rate increase. Now, they seem decided that a rate cut is looming. In fact, by late June, the Fed futures were calling for a 90% chance that the Fed would cut rates as early as this July, which we've seen happen. The news of the looming interest rate cut sent markets spiraling upwards, and on June 21st, both the NASDAQ and the S&P hit record highs again. While June is historically not a strong month for the markets, especially after a weak May, this year has proven an anomaly, as we ended June with U.S. equity markets up over 7% for the month. As far as equity markets go for the first half of 19, it's not been abnormal in directional terms, only in the levels of magnitude of the movements. It has been common for the market to experience ebb and flows even in a sustained bull, which has been the case since 2009, 2011, 16, and also Q4 of last year examples. What has changed is that volatility can return like lightning after prolonged periods of calm. The ubiquity of algorithm computer-driven trading contributes to this, as does our almost limitless instant access to information and manic-driven financial media. Downdrafts are swift and violent, and we are the ones who are always almost caught flat-footed. This is all the more reason why it's important for us to meet to review your goals, and if those goals remain unchanged, it's imperative that we stick to your established plans. The watchword for today's market is vigilance. What would a halftime report be without a peek into what we could expect for the rest of the year? Our top 3 concerns, in no particular order, are as follows. Number 1, a deal with China. First up is the G20 summit, which happened late 2 months ago. Markets were upbeat after Trump and Chinese president confirmed the trade talks were resuming. If we get signals that a deal is near and there's follow through, we'll see a very strong market in the late summer and into the fall. And if we do not, we can expect to be punished just like we were this past May. Next, secondly, interest rates. Following its June meeting, the Fed had a noticeable shift in its language regarding possible rate cuts, which we've seen happen one time now. As mentioned before, Fed fund futures are pointing to the high probability of future rate cuts, There could even be the possibility for multiple cuts this year. If the Fed can walk this tightrope, markets will be fine. If economic data clearly points to a need to tighten or of a risk of inflation and the Fed signals it may not cut or even raise rates, expect the market to react similarly to what I just described if there's not a deal with China. Finally, attention in the Gulf. Iran has been pushing our buttons lately, attacking 2 tankers in the Strait of Hormuz and shooting down a U.S. naval reconnaissance drone. Tensions are high. Although President Trump didn't show restraint when he called off a retaliatory strike at the last minute, the situation with Iran could, over the long, hot summer months, that's not a sentence.
No, it is not.
That's the same thing I got hung up on. Finally, tension in the Gulf. Iran has been pushing our buttons lately, attacking 2 tankers in the Strait of Hormuz and shooting down a U.S. Navy reconnaissance drone. Tensions are high. Although President Trump did show restraint when he called off a retaliatory strike at the last minute, the situation with Iran could build over the long, hot summer months. This is the wildest of wild cards, and markets don't like oil supply disruptions or surprises in general. For the second half of 2019, there's more probability that the markets will not be as strong as they were in the first half. My prediction is another 4 to 6% upside in the second half, with the 10 years Treasury at 2%. That's not too bad. We just have to make sure that the Fed and China trade talks deliver. The biggest thing you can do as we head into the second half of 2019 is to rely on us. We encourage you to stay disciplined, and we are here to remind you of your plan while providing you with the support on your path towards meeting your investment goals. We're always here to help you make sense of what's happening in a constantly changing world and to help you navigate constantly changing markets. Have a great day and a great rest of your summer, and we'll speak soon. Thank you so much for your time and trust in our firm.